Hey guys, this lecture will focus on how monetary policy conducts interest rates in order to maintain our external stability. Now, external stability is usually focused on by budgetary policy or fiscal policy, but in some cases, monetary policy can in fact impact our external stability. So external stability is characterized by three things: our CAD to GDP ratio, our net foreign debt, and our dollar. So the most important part of this external stability goal is this CAD to GDP ratio of around 3-4%. I'm going to focus on how interest rates can actually impact this CAD to GDP ratio. Right. So let's focus on the CAD in this lecture. Now that's the primary focus that we're going to go through. Alright, so now we know the CAD, or the current account deficit, is caused by two major factors. Firstly, the balance of on goods and services, and secondly, the balance on primary incomes. So we're going to go through these two balances systematically and see how changes to the interest rate could actually affect these two balances. So firstly, we're going to look at the balance on goods and services, and this relates to exports and imports. And as we know, exports and imports are the sale or the purchase of goods and sometimes services between foreign countries. So the most important effect that we need to look at that affects our exports and imports is the Australian dollar. And as we know, the Australian dollar is also known as the exchange rate. And as we talked about in our lecture on interest rates and exchange rate, we can see that how there is a direct link between interest rates here and the Australian dollar, the value of the Australian dollar. So as we talked about in the lecture on interest rates and exchange rates, we saw that with high interest rates, this meant that our securities are more attractive to international investors, and that means they would purchase our securities, and so that would push up the demand for the Australian dollar and push up our exchange rate. So that would lead to an increase in our exchange rate. And by the same logic, a lower interest rate or an expansionary monetary policy would actually put a downwards pressure on the exchange rate. So what we're going to focus on is let's look at contractionary monetary policy with high interest rates and how this would affect the exchange rate. High interest rates would actually increase the exchange rate and therefore makes our exports less competitive, because international purchasers would have to use more of their domestic currency in order to exchange for the Australian dollar and therefore purchase our commodities, and that would make our commodities relatively more expensive internationally. Similarly, imports become cheaper because we need to forego less of the Australian dollar to convert to other currencies and therefore purchase the foreign goods and services at a lower price. So imports become more competitive, exports become less competitive, and so as a result, net exports would actually decrease, so even approaching negative. So we have more imports than exports. So what this means to the balance of goods and services is that I'm going to note the balance on goods and services, or BOGAS, my terminology, so don't use that as a reference on balance on goods and services, but this is just an acronym that I just made up then. The balance on goods and services, that would mean debit exceeds credits, and that would lead to a larger current account deficit. Now let's look at this, how interest rates could actually affect our current account deficit through primary incomes. Now, as we know, in previous years, Australia's balance on goods and services is relatively positive because of the mining boom that we've experienced. So we're exporting a lot, and because of our high dollar in recent years following the GFC, our imports have become more cheaper. So that didn't really explain this high CAD that we still experienced over the mining boom period. So this balance on primary incomes here is the primary reason as to why we had a very much negative balance on our CAD. So another acronym that I'm just going to make up, balance on primary incomes, or BOPI. We're going to see how interest rates actually affect the balance on primary incomes. So as we know, if we go back to our lecture on the current account, the balance on primary incomes include interest rates and incomes paid into Australia and out of Australia, based on investments or relative investments made within or between countries. So as we see, with a higher rate of interest here, this is due to, or this will result in a greater number of investments made to Australian securities. So with higher interest rates, I'm just going to note here, more investments made into Australia. So although that represents a credit or an inflow of capital into the Australian economy, and this is recorded as a credit in the capital and financial accounts, we do have to pay interest on these investments. So when a foreign investor buys our securities, that means that will represent a flow of income into the economy, and that would be represented or recorded in the financial account. But however, that would also mean that we have to pay interest repayments to that foreign investor, and that would be recorded in the primary incomes category in the current account, because that represents day-to-day transactions rather than non-current transactions. And so what we see with high interest rates is that debit again would exceed credits on the primary incomes account, and this is primarily due to this fact of interest repayments on investments, especially securities and financial instruments, financial debt instruments. And so as a result, that would again cause an increase to our current account deficit. So with higher interest rates, we can see that the external stability may be, or the goal of external stability may be compromised in that our CAD to GDP ratio may increase, and that would cause our net foreign debt to accumulate even greater over the years, and the dollar will be affected due to prevailing economic circumstances on our exports and imports. But primarily, interest rates will affect both the current account deficit in the short term, and therefore in the medium term affect our net foreign debt. And those being two of the three pillars of external stability, we can see that high interest rates may in fact compromise our external position. However, lower interest rates would mean that our Australian exchange rate would depreciate. When it depreciates, it makes our investments less attractive to overseas, or because of that low interest rate, because of the closing interest rate differential. And so that means our credits would actually increase relative to debits, and so would our credits increase relative to debits in both the balance on goods and services and the balance on primary incomes. But that may not be necessarily a good thing, because it does void us of the capital inflow from other countries in order to maintain our national savings and investments equilibrium. We're going to talk about national savings and investments in a further lecture, and why it is important for capital inflow in order to expand our investment and therefore productive capacity, and consequently our aggregate supply in the economy. But for now, we can see that interest rates can affect external stability rather directly through the higher interest rates, how that affects the exchange rate, and therefore both balance on goods and services and primary incomes, and the same with low interest rates as well.